Well, good day, everybody, and a happy new year to you all. Thank you for joining us for our quarterly update on REIT performance. This time it's for the fourth quarter of 2025. We'll also take a look ahead to what can be expected during 2026, perhaps even which property types we should be embracing and which we should be holding at arm's length. My name is Mike Consol, and I'm editor of Real Assets Advisor magazine, one of six titles published by Institutional Real Estate Incorporated, which is co-producing this webinar along with NAREIT, the National Association of Real Estate Investment Trusts. NAREIT is being represented by John Worth, Executive Vice President of Research and Investor Outreach for the organization. Also joining our discussion is Ji Zhang. She is Senior Vice President and Portfolio Manager of Global Real Estate at Cohen Steers. Now, as those of you have been to our webinars before know that we invite your questions in writing, and we like your participation from beginning to end. So there's no need to wait for a Q&A session at the end. There is no Q&A session at the end. We want your involvement from the beginning to end. So feel free to go ahead and write your questions in. I won't use your full name, just your first name, if even that. If you've got a very telling first name like Rembrandt or Madonna, I will refrain from using that. Also, this webinar is being recorded, as we always do, and a copy will be sent out to all who have registered. And the webinar will be published on both the IREI and Real Assets Advisor websites. So with that, John Worth and Ji Zhang, welcome to the both of you. And John, as always, we're going to start with you. Give us the quarterly rundown on how REITs performed during that final fourth quarter of 2025.
Thanks, Mike, and happy New Year to you. I know it's past the Larry David cutoff, but still looking forward to a great 2026 of doing these webinars together. I'll show a couple graphs just to walk through quarterly and 2025 returns, both in the aggregate and by property sector. And so as you can see here, we're showing quarterly returns back from 2019 through the fourth quarter of 2025. And as you can see, it was a down quarter for REITs. In particular, REITs had a tough December, falling more than 2% after posting positive returns in November. And so that resulted in REITs delivering returns of minus 2.1% for the quarter, but positive returns of 2.3% for 2025 as a whole. I think the general consensus, I think, was relative to expectations coming into the year. That was something of a disappointment, and even in a way a bit of a frustrating year, in the sense that REITs really delivered very solid operational performance over the year. If you look sort of over the first three quarters where we have results compared to 2024, in aggregate, FFO was up more than 6%, NOI was up nearly 4.5%, dividends were up more than 6%. So REITs were able, in a difficult operational environment that we'll talk about with a lot of uncertainty, we're able to really deliver in terms of operational performance, but certainly versus the S&P 500 and tech stocks, were not necessarily rewarded by investors in terms of returns, and that'll set the stage, we think, for 2026. When we go taking a look at some of the property sectors, and here you can see we've got full year results on the left-hand side, fourth quarter results on the right-hand side. And you can see healthcare, the best performing property sector in 2025, total return of 28.5%. Healthcare was up just 1.4% in the fourth quarter and gave back some gains in December. Industrial rallied in the fourth quarter, up 9.5% to be the second best performing property sector at 17% for the year. Really a pretty interesting recovery from a sector that was really battered by trade news earlier in the year, but showed a really strong recovery and strong, I think, demand trajectory at the end of the year. Diversified, which is a very small sector in the U.S. REIT market, up over 15% for the year. A lot of that driven by net lease REITs in that sector. And then retail and gaming sort of rounded out the sectors with with positive results. Retail up 5%, gaming up just over 1.1%. Although gaming had a tough fourth quarter, as you could see, down 9.7%. In terms of sort of the bottom of the chart, we can see data centers, the worst performing property sector at negative 14%. I know we'll dig into that. Obviously, big divergence between data center performance and I think a lot of the discussion around data center and the massive investments we're seeing going into data centers generally. Um, Office had a very tough December and a tough fourth quarter, putting the minus 13% for the quarter, and that puts Office down 14% for the year. Office had a pretty good 2024 at the end of the day, up 21%, but definitely seeing some reversion and real caution for investors around Office. And then self-storage, residential, specialty, and lodging sort of rounded out the sectors that underperformed the index. The one on note, telecommunications, which had been having a very strong year. Again, tough end of the third quarter, in fourth quarter down 6.3% to end the year down just 0.5%. So with that, let me stop sharing. We jump into the conversation.
Yeah, G, any thoughts on that? I mean, data centers, everybody's so hot on data centers, didn't have a great run of it. Healthcare's often problematic. It did very well. What stood out to you?
So I think it's important to look at the fourth quarter in the context of full year 2025. So I'll start on the positive, which is at least we were positive. We put up positive returns. So that's a good start. And I think when I look at 2025, what worked was things that had growth. And that's why healthcare, especially senior housing, because it was able to put up growth rates that are quite competitive relative to what we saw in the broader equities market. Those stocks were able to keep pace, if not even outperform what we saw in the S&P. Data centers is a slightly interesting story, and in a way, and you kind of need to look at that in the context of the last couple of years. It came into 2025 after a couple of years of pretty massive outperformance. But with that said, we still think valuation is pretty good. We still like this sector. But when you compare the data center REIT growth relative to the growth that we see elsewhere in AI, it wasn't putting up the 20, 30, 50% growth. So I think there was sort of an obvious tilt towards the more growthier ways to play AI. But with that said, we all know that REITs is a long duration asset class, and there's a lot of embedded growth in those companies today because of all of the leases that are significantly below market rent. So that's a really favorable setup over the next 3 to 5 years in terms of sustained and accelerating cash flow growth.
Yeah,
John,
Mike, I
oh,
just
go
jump
ahead.
on just one thing to expand on the data center because G really I meant to mention that negative 14% that's riding on the back of plus 25 plus 30% returns the last 2 years, which I think is absolutely critically important. But I also think there's a lot to like, and this is really providing maybe some real opportunities in the sense that you've got great credit quality of the tenants, a terrific demand profile for data centers generally, and a lot of CapEx going on that looks like it's going to be very accretive to growth and earnings that may have, I think maybe have scared some generalist investors away because they were worried about near-term earnings results, which ended up being quite strong. So I think there's a lot to like in the data center space.
That's a great point, John, and it's actually one of our highest conviction sectors right now, especially given that lag in performance. So the valuation setup is quite attractive. But to your point, when you kind of think about the technology cycle, I think the last year has been buy everything AI related. There was no need to discriminate between market quality. It was more about quantity over quality. But what I really like about how the REITs are positioned within the public markets is that they are focused on quality. right? So as we get more discerning about who are going to be the winners and the losers within this arms race for AI and which markets are going to be the winners and losers, we feel really confident that even though the REITs didn't participate in all the growth in terms of volume, they didn't go to the Western Texas and the Oklahomas and Missouris. But at the same time, because they were focused on the primary markets where you see the most resilience and the greatest pricing power, when things do get frothy, and we get that question a lot, are we in an AI bubble? Well, one day there will be. And when we see that pullback, that's where you will see that great dispersion between the primary markets versus some of these more emerging markets that some of them could do really well, but there could be more pain down the line in some of those markets that the REITs have stayed out of.
John, in addition to the chart you showed us, Nareit did recently publish its annual outlook. And according to my notes, one of the key themes is the dual divergence between REITs and private real estate and REITs versus equities. Expand on that if you would.
Yeah, thanks, Mike. And one of the things that as we were sitting down to think about 2026, and kind of how 2026 might emerge, one of the things that really struck us was that we were in this unique position where we've had this now, almost 12 quarters of divergence between public and private valuations. And what I mean by that is what we saw when rates started to rise a couple of years ago, we saw REITs essentially bake those higher rates into their valuations almost immediately. So we saw REITs down almost 25%, and they've been recovering in a recovery mode ever since. Private real estate has been much slower to undertake that revaluation process. So even today, when we look at cap rates, we see a divergence of north of 100 basis points between REIT cap rates and private real estate cap rates, and one that we think is more appraisal driven than reality driven, because when we're seeing transactions, they're occurring much closer to the REIT valuations. And historically, what we've seen is that divergence does close. This cycle has taken an extraordinarily long time to close, but it will ultimately close because we've got the same assets on both sides of the marketplace. But then adding to that, we now have this divergence between REITs and equities that really stood out sharply last year. And I'll just show one quick graph just to illustrate that. And here we're just showing you a graph that we use in our year-end outlook that just is really the S&P 500 price to earnings divided by the equity REIT price to FFO. And you can see over time that ratio has been about 1. But here we're in this very sharp divergence where S&P 500 broader stock market valuations have risen dramatically, really on the back of a few stocks, all pretty much tech and AI driven, whereas REITs really moved pretty much sideways this year. And again, historically, what we've seen is this divergence, it doesn't last forever. It closes up. And in both of these divergences, both with equities and with private real estate, when those divergences close, we see REITs historically, again, outperform pretty dramatically during that convergence process. So, we view in retrospect, 2025 is this period of divergence. And we think that, history tells us at least that 2026, we should see convergence in one or both of these markets. And that tends to be really good news for REITs and REIT investors.
Yeah, the public versus private rages on, Ji.
Yeah.
What about public versus private during fourth quarter, during 2025, and maybe looking ahead?
Yeah, I think John made a lot of great points. One thing I would add to the public versus private, and I do think, first of all, there is a place for both in, asset allocation and in investors' portfolios, and they sort of do different things within the portfolio. But I think what investors need to be mindful of is that the composition between what is in the public market versus what is often available in private real estate portfolios are quite different. And if you look at some of the more legacy private real estate portfolio, let's just take the NCREIF Odyssey Fund as an example. It is primarily multifamily and industrial with sprinklings of, office and retail that are from, years back. Whereas in the public market, you do have access to, and when we look at this, is over 50% of the universe are what we call next gen sectors that really have great secular trends like healthcare, like data centers, like towers to some extent. So I think that composition is different. And back to John's point about the valuation lag, like you really can't compare those two sectors, like just put them on top of each other because the mix is different. But when we look at where public market values are for industrial versus private market, when we kind of put those sectors on top of each other, there's still 150 to 200 basis points of spread, meaning you can get the same thing, which we might argue could be better quality management teams, better quality assets, because these are infinite life vehicles. But let's just say like the quality is the same, that you can get it much cheaper in the public market. So there's a pretty obvious arbitrage opportunity between listed and private, but longer term, we think both make sense just because, they are inherently different and address different types of investor appetites.
Let's jump back to data centers for just a minute. One of our audience members was asking if there's any concerns about data center obsolescence as leases expire and also the capital expenditures that would be needed to make them current. I think just to piggyback on that, I think we should also address the energy issue where there are communities now that just say, no, thanks. We don't want the data center. We don't have the energy for it. I mean, some of these data centers use up as much electricity as a small city or a town or a small city. It's pretty extraordinary. But what about CapEx, obsolescence, and those energy questions? Ji, do you want to start with that one?
Sure. So I think when we look at the obsolescence and CapEx issue, and we spend a lot of time on this, I do think that operators and developers need to be very cognizant of building a flexible design that can be changed and catered as the technology changes. So we're in a world where the changes around technology is very rapid, whether it's the energy efficiencies, whether it's the cooling methods. The chip makers have been talking about and innovating on technology where they don't need cooling, and that has implications on how you build. So I think having that flexible model is really important. But with that said, when we look at the CapEx that is needed, we do think that there's 2 points to that. One is I do think that is embedded in any data center investors underwriting. We do have elevated CapEx assumptions when we think about data center portfolios and that recurring kind of pace to maintain and keep up with technology changes. But two, we're also seeing a world where a lot of times the customers and the tenants pay for sort of some of those retrofit costs in order to put in higher end chips or put in, more energy consuming chips and things like that. So there's also a question of if you're in a world where there is a very skewed supply and demand, which is the world we're in today, and that's why we've seen really strong pricing power in data centers. The customers, the landlords have more leverage in today's environment, and the customers are paying for that. On the energy consumption side, Mike, I would say that that's a huge concern, and we are seeing more and more, political noise around the energy consumption of data centers. On one hand, I do think that it has some implications for the supply chain in terms of could there be an oversupply of chips because there's not enough power to meet the demand. But on the other side, as a data center landlord, and this is our general view of sort of how do real assets perform in an inflationary environment, there's just not going to be enough supply. And that means existing landlords have continued pricing power. So even though you might not be able to gain the volume, you're going to see better cash flow growth because you're just going to have to charge a lot more for the existing capacity. So it's a little bit of a double-edged sword. But for those that are disciplined, and for the landlords, I actually think is a good thing. But if you're a tech investor and you want to see that continue CapEx, continue revenue growing to the sky, then maybe there is a limitation on how much that can grow because we are going to be in a power constrained environment.
I just add one thing, which I think Xi's last point is a great point, and really is kind of a key differentiator as we're talking to institutional investors who want to get more access to data centers in their portfolios. This notion of investing in REITs where you're getting a portfolio of data centers, the U.S. listed REITs own 500 data centers. Um, Plus development on top of that versus going into a fund that's a pure development vehicle. When you enter into a period where energy is more difficult to tap into, you may have more community constraints on building. I think you're in a really advantageous position when you have the portfolio that's already in place deriving rents, and then you're doing development on top of that versus a pure development play. So we think it's really a much safer way to kind of play the AI boom in a lot of ways.
John, let me stick with you on this next question. 2025 was an unusual year in this regard. Europe, European and Asian REITs outperformed U.S. REITs. We really invented the REIT decades ago. It's spread worldwide. They appear to be catching on in a significant way and moving past the United States, at least for 1 year running. Why the differential between Europe and Asian REITs versus the U.S.? Any clear indicators there?
Yeah, it was a very interesting year, and I will say it was particularly interesting to us in the sense that coming into this year, we had actually had conversations with a number of investors who sort of said, we've had a global REIT real estate portfolio. We're thinking maybe we're done with that. We just want to have a U.S. focused real estate portfolio, just because the U.S. had sort of really been consistently outperforming. In fact, if you look over the last 10 years, REITs really sort of, outperformed significantly versus both developed Asia and developed Europe. And the same was true over the last 5 years. In 2024, 2025, partly because of the sharp decline in the dollar, we saw globally the index was up about 10%. It wasn't a bad year for global investors. The North American component of that was up just 3%. Developed Asia was up almost 30%. Developed Europe was up over 21%, all in dollars. So some of that was really driven by exchange rates, which were an important component. But we also saw that there were some sectors globally that performed quite well, where they weren't performing well in the U.S. Office really stood out. We saw office performing quite well in Asia. It's a small sector as a standalone in Asia, but up almost 35%, up more than almost 11% in Europe, whereas obviously it was down about 13% in the US. And then we saw the diversified REITs that really dominate Asia did quite well, up more than 30%. The diversified sector in Europe also, accounts for more than 20% of the market cap there, up almost up more than 27%. So I think, we view it was a combination of, different fundamentals, both economic and in the real estate markets, and then the dollar decline really kind of added on to that sharp differential. But it was definitely a year that sort of made the case for why you would want to go with a global portfolio as opposed to just being in one region, because this year showed the real value of diversification across geography.
Yes, yeah.
John, I think investors were also, over the last decade, have probably been pretty under-allocated to non-US markets at that point. So I do think there was, incremental interest in Europe and Asian countries. So there was some period of normalization that sort of happened in 2025. And to your point, I 100% agree that diversification, I think, is increasingly important because we're going from a world that was pretty synchronized over the last decade to when you look at the monetary policy, the fiscal policy, the underlying real estate fundamentals, and like even within, sector by sector, how people sort of live, work, play, like all of those things are quite different globally. So I do think that 2020, 2025 was a year of recognition that I don't want to have a very US concentrated portfolio. I kind of want to have exposure to different economic cycles and different real estate dynamics. With that said, I still think people are very heavily under allocated to REITs in general, and even US REITs. So I do think, we're still quite positive on US REITs.
Yeah,
Gee, the other.
oh,
Oh, go
sorry, Mike.
ahead,
I just
John.
just one thing to note. I think that's absolutely correct. When we do a global active managers report each quarter, and it's interesting. The U.S. accounts for about 2/3 more or less of the FTSE EPRA Nareit developed global index, but active managers were well north of 70% exposure to the U.S. Part of that driven by wanting to get data centers, wanting to get cell phone towers, which are all U.S. listed, but definitely active managers, even heavier preponderance of capital in the U.S. than the index.
Mhm. Gee, the REITs in the United States lagged behind the broader equities market. For a long time, people have argued that REITs act more as equities in the market than they do counting real estate fundamentals. What happened there? Why was it? Maybe that isn't the case. That argument isn't the case so much because it did lag the broader equities market. Any explanation for that?
I think a big part of sort of the AI conversation that we've had, that because the outlook and the growth in the Magnificent Seven complex was, so significant that it was difficult for REITs to keep pace. But also, if you take a step back and think about what's happened over the last number of years, not only did growth lag, but we've sort of been in this environment of there was a lot of pandemic distortions across both supply and demand in real estate sector. So storage, I would say, was more on the demand side in terms of there was a very elevated demand during the pandemic that had needed a period of normalization. Of course, we had the challenges to the housing market. Industrial did, have a nice pickup, but fundamentally, we've been in a period of, a lot of leases signed for e-commerce during the pandemic, and that had to normalize. And of course, we had the tariff noise. And then, of course, with Sunbelt apartments, we had a period where there was a lot of supply that was being started and in the process of being delivered and absorbed to meet the migration demands into Sunbelt markets during the pandemic, and we're working through that. So I would say fundamentally, even though things, at a surface level were pretty good, there was a lot of noise across core real estate sectors that were impacted by what's going on in the last couple of years. And then when you add to that the unprecedented volatility in interest rates just meant that we, as an asset class, became an interest rate proxy. And the correlation to real rates was, over 90%. And as long as that interest rate volatility continues, and we do think that over the next 12, 18, 24 months, yes, we're going to debate if we're going to get one cuts or two cuts, but we're not debating 100, 200 basis point ranges in terms of interest rate. That volatility will come down, and that should bring more interest back to what is ultimately a relatively stable and predictable sector from a cash flow standpoint. So as we look out to 2025, what are the things that we're really positive and we're really encouraged about that is different from 2025? Obviously, the valuation has been there and it's been cheap for a while. But our investors always want to know, like, yeah, you're cheap, but what is the catalyst? And I think the catalyst is getting past some of the macro headwinds over the last couple of years that are turning into tailwinds with, the Fed and global central banks exiting their tightening cycle. But at the same time, that fundamental inflection, which is going to happen throughout the year, is not all happening January 1st. But if you think about the supply in Sunbelt apartments, and if you look at the normalization in demand for industrial and self-storage sectors, some of those sectors that have been really impacted, we do think that there is a fundamental recovery that will become more obvious, and that will sort of be the third leg of the stool that the market needs to see to get more interested in REITs.
Mm-hmm. Mm-hmm. John, one of our audience members is asking about one of the slides you put up. It says, regarding the slide comparing the REIT FFO multiple to the S&P multiple, how are those multiples calculated? Is that something you can summarize in shorthand?
Yeah, sure. These are kind of you kind of use the traditional approach, which is, it's price versus the projected forward 12-month earnings. That's kind of the sort of standard approach that is typically used when you see those price to earnings multiples for the broader stock market. We replicate the same using FFO, which is the REIT metric of earnings. So it's a pretty apples to apples comparison, and it is forward earnings. I think that's the most important aspect there.
Mm-hmm. So healthcare led all sectors, as you pointed out, John. They led all sectors in the REIT index. Healthcare includes senior housing. Is that correct, John?
It does, yes.
Okay, and senior housing has been all the rage lately. The silver tsunami is finally landing on shore, supposedly. Is that what's been driving this, or are there other components that you would cite?
Yeah, I think a big driver. We've seen strong performance across really all the aspects of sort of what we consider healthcare in the index, with the one exception being sort of lab space or sort of scientific space, which still has real supply demand issues. But I think senior housing kind of has been the tip of the spear in a way, in terms of pushing the growth in that Ji mentioned earlier about how the healthcare space has been able to show growth that has really been on par with, if not above, what you've been able to get out in the broader equity space. And some of that, I think, was really driven by, in some sense, echoes of COVID. We really had a period starting in 2020 where nobody was breaking ground on new senior living facilities, and that persisted for quite some time. It was then exacerbated by if inflation, in particular the high cost of building materials, and that really created a great supply demand dynamic in the sector that we've seen in terms of pricing power and the ability for rents to grow. I think we're now seeing more supply coming online in that space, but the demand of those 80 plus, the sort of, typically it's somebody in their 80s who's going to be the typical tenant. That cohort in our population continues to grow. I don't like the term silver tsunami, but Mike continues to use it. But
Might have to do with our hair color, John.
yeah, I mean, are we going to be roommates, or but yeah, I think the supply demand conditions have really been positive, and I think some of the REITs in this sector have really done innovative things in terms of how they're tapping into these markets and how they're understanding where demand is going to be the strongest, and using some things like big data and AI to really help tap into these markets. The last thing I'll just note, because it just following on some of the things that Ji said, I think that those supply demand conditions that we're seeing in healthcare, I feel like with the slowdown in new supply and some other sectors, retail really comes to mind for me. We may see other echoes like this, where we see sectors where we see supply demand just not just stabilize, but really turn into a really positive supply demand environment.
Mhm.
I agree. When we look at the construction starts in 2024, Mike, we like across the core real estate sector, they're down anywhere between 50 to 70%. And also within senior housing more specifically, and of course across different property types, it's different lead time in terms of start to finish. So for multifamily or industrial, just depending on the market you're in, it might be 12 to 18 months, but then senior housing, it's like 3 or 4 years. So we have this 3 or 4 year window where even if we start to see incrementally higher starts, we're really not going to see any product, any deliveries for a while demand is accelerating even more so. And I think, John made this point about REITs specifically within senior housing. And I think across most property sectors, we see REITs generally outperform some of their private peers in terms of, net operating income growth and all of that occupancy rents. But it's really quite pronounced within the healthcare space, more specifically senior housing, because of that operating platform and AI John talked about. And they have done a really good job of partnering with the best operators in the space. And healthcare as an industry, because it's so operationally intensive, like there really is a quite big difference between the have and have nots. So I would say we like healthcare as a sector broadly, but senior housing stands out quite a bit in terms of the operating performance. And that's also driven their acquisition engine in terms of being able to find underperforming assets and really change the trajectory of the cash flow growth for those portfolios once they put it on the REIT platform in terms of growing occupancy, improving margins, improving rents, and whatnot. So that I think, it's obviously work and it's done well, and we're spending a lot of time thinking about what is the right valuation or right multiple, but I do think that is a sector that has quite durable demand drivers.
Before we get too far along, I do want to ask, and I think the timing is probably good for this, just looking forward to 2026. John, I'll start with you. What property types are you feeling are going to be the high performers versus those that are going to be lagging? I realize that's a tough question for you. You love all your
We
members.
love them all.
You want to sprinkle sugar on them all, but we know that that's not reality. So do the best you can, and we'll see what G has to say after that.
Yeah, just sort of echoing a bit of G, I think that, healthcare will continue to be a really strong operator. I think, both the fundamental demand conditions as well as supply conditions really line up very nicely for that. I think we're going to see a recovery in data centers. I think that we're going to find that 2025 was really something of an anomalous year. I think the demand conditions and sort of the quality of the REIT portfolios and the ability of them to do development on top of those portfolios is really going to be hard to miss out on in terms of having strong performance. The other sector where I feel really good is retail. I think that retail has been a little overlooked over the last couple of years. But again, we haven't seen much supply come online. And we've seen, both the mall sector. We've seen, a real total sweeping change in that sector where the REIT owned malls, which tend to be the highest quality malls, they're having great operating performance. But also the grocery anchored strip centers have really evolved over time. So and the net lease businesses continue to really grow and scale. So I'm pretty positive on retail. And then I think that broadly, our general sense is that the entirety of the sector in terms of REITs has really kind of in some ways, suffered a little bit in comparison to broader equities and the divergences that we've talked about. And we think as those divergences close, that kind of tide will really lift all the boats. We think we'll see, really broad-based performance in terms of as we see investors coming back to REITs, coming back to more of the stable cash flow proposition that REITs offer. We'll see broad performance across the sectors when we see that convergence.
G, what do you think?
So I think it's pretty obvious at this point of the webinar that John and I both like data centers and senior housing. So those are probably still our top picks. I think the slightly more controversial one, but we feel quite good about, is office. And I don't think it's all office everywhere, but I do think that the higher quality portfolios, the office portfolios, can do quite well, especially coming off of the underperformance in 2025. So here are a couple of things that we feel really good about within office. We already saw that pickup in leasing activity in 2024, and REITs gained significant leasing activity that will eventually flow through to higher occupancy. We are starting to see rent inflect quite positively, and I'm short of using the word rent spike, but we're getting close in certain cities like New York City office, and we're starting to see more leasing momentum in San Francisco. So I think we're starting to see the leading indicators of an inflection in earnings growth. Now, obviously, office had lagged in 2025 because investors will look at the earnings growth and say, where's the growth? But as investors that want to be ahead of the market, and when we look at all of those indicators that are pointing to earnings growth, we feel quite good about how specifically the REIT portfolios are positioned on top of, inflecting fundamentals and the REITs because they're well capitalized and own the better portfolios within all of the markets are able to, and they have, continue to take share within the office space. So that's a sector that, we have been quite cautious on since even before the pandemic, 2017, 2018, because as we all know, it's a very heavy CapEx business. But at today's valuations, I think a lot of that is priced in. It's pretty under-owned, and I do think that the capital will start to recognize that inflection in fundamentals, and I think that could be a really interesting one.
Let me get to a couple of our questions from our attendees. I'm going to give this one to you, John. It's what are your views on REITs in M&As and IPO activity in 2026? And then, Ji, I want to come to you with a question about another member of the audience saying, what are you hearing from institutions regarding usage and changes in REITs in terms of he goes on to say, seems like liquidity and diverse exposures would be pretty attractive given valuations and potential broadening. John, but what about M&As and IPOs? Is there any indications that 2026 is going to be a bigger year than usual for that?
Yeah, I think that we may see some IPOs in 2026. I think it really depends kind of on where valuations line up. In terms of M&A, we saw a little flurry at the end of the year in terms of REITs leaving the market with some privatizations. Those tend to get a lot more attention, I think, than sometimes they merit. What the REITs we've seen go out were really very, very small cap REITs. It was a very, I think in combination, it was all less than a percent of the broader market capitalization. Those can be helpful in terms of helping to reset some valuations, and all of the privatizations that took place did take place at pretty substantial premiums. So that was some positive news. We may see some more of that depending on where valuations sit. I tend to think that kind of when we look back, we'll see that the M&A that really mattered in some ways over in 5 or 10 years is the REIT to REIT M&A, where we've seen REITs, and we haven't seen much of this lately, but where we've seen REITs combining within property sector to grow that operating platform, essentially get bigger, get the scale they need to do some of the things that Ji was talking about before in terms of investing in essentially R&D, in terms of data science, having just a really strong operating platform that then yields benefits for years to come. So I think we don't have any specific forecast. I think we could see some of the privatizations early in the year before we see valuations adjust. But I think time will tell, and the ones that really will matter, I think, are when we see REITs combining to grow that operating platform.
Mm-hmm. Mm-hmm.
John, I do think M&A sets a floor for some of those sectors that are trading at significant discounts to net asset value, whether it's in the U.S. or Europe or whatnot. When I go to some of those private equity forums and panels, and when you ask them, like, what is the most glaring opportunity within real estate today, they would say the public REIT. So I think a lot of them are sharpening their pencils. Obviously, we want the best companies within the public market. So selfishly, I don't want them to be taken private. But at the same time, I do think that sets a reasonable floor in terms of to the extent there's areas where there is glaring discount, like apartments, for example. Like I do think that M&A is sort of that optionality for those companies.
I totally agree, and we like having REITs in the industry, but we fully recognize part of what makes REITs tick is the fact that you've got two sides of the market, the public and private market, and you have an exit in either direction depending on valuation, and that's what helps bring arbitrage to the market. That said, I don't think we're going to see because REITs aren't in any distress, right? They don't have high leverage, they've got good operating performance. They're not gonna sell themselves at a discount. So you're gonna have to pay up a full premium to get them.
Right.
Gee, what about institutional investors and what are they doing with their portfolios? Are they all in with the real estate sleeve into publicly traded REITs? Do you see changes happening there? Are they reconfiguring for 2026?
I would say it's a little bit hard to generalize because, as you know, Mike, when you look at the institutional investors, the risk appetite and how they think about risk-adjusted returns is quite different depending on the type of institutional investor you're talking to and what their sort of ultimate investment goals are. And I would say it also it's a little bit different whether or not REITs are part of their equity sleeve or if REITs are out of their real estate sleeve that they're able to think about public versus private. But the good thing is, and John talked about this too, whether you're comparing REITs versus private real estate or you're comparing REITs versus equities, it's cheap no matter how you spin that. So I think there's an obvious opportunity. And I think what we're hearing from investors is that most feel like they have been underweight REITs for the last number of years. And that's, of course, backwards looking has been the right call, but many are feeling like they are probably too underweight. So they need to, before they get to overweight REITs and getting really, really excited, they need to start closing that underweight. Of course, for us, that's things are moving in the right direction, and we hear that in our conversations. People are feeling things are moving in the right direction. In the early 2021, 2022, it was more like, please convince us why we should own REITs. Today is more, how should I be thinking about the timing of maybe I should revisit my REIT allocation? So I would say things are gradually turning the corner. I wouldn't say it's a complete 180 in terms of how they're thinking about REITs because they're still unwilling to let go of their Max 7 and AI names. But at the same time, there certainly is a recognition that things can't last forever and you need to diversify your portfolio. And even if you have a portfolio that is S&P, the reality is it's a huge play on 7 names in the index, and that's probably not a sustainable or responsible way to think about allocating your portfolio longer term.
Hmm.
Yeah,
One of
Mike,
our
I'll just
audience
add
members
one.
brought.
Let me
Oh,
just add one thing because I do think there's something interesting sort of percolating out in the institutional investing world that we're certainly paying close attention to is this kind of growth and interest in kind of the concept of the total portfolio approach as opposed to strategic asset allocation, where essentially you're seeing some institutions and we saw CalPERS announce that they're going to try to adopt this approach in their portfolio. CPPIB, some other large global pensions and sovereigns, and that sort of approach requires more flexibility across asset classes, a little bit less of a sort of set real estate at 10% and kind of don't check back for the next 5 years. More potential for different allocations across asset classes. I think that as we see that adopted and more institutions thinking about that, we think that creates some positive momentum as well for REITs, simply because in order to conduct an allocation like this, you need to have more liquidity than you can get with a purely private portfolio. So our expectation is over time that could also be a positive momentum driver for institutional investors' adoption of REITs.
So we have an audience members asking a question that was in the news this week. The Trump administration came out and said, "Hey, those of you big investors buying single-family homes to rent, we're going to outlaw that. We're basically going to create regulations against that." And what she is asking are these changes regarding single-family residential ownership, will they impact the build to rent or the single-family rental sectors? G, you want to take that one?
Yeah, I think there's been, and look, I think that's one of the risks in 2026, that there's just going to be more political and geopolitical headlines and uncertainty, not just for REITs, but across sort of the global investment market, whether you're in defense or you're in housing, data centers. I just think that is going to be part of the norm. So maybe in 2026, and I don't know, maybe we're not going to be talking about tariffs, but we're going to be talking about a lot of other things. But with that said, I do think the institutional market should be part of the solution for housing, than being viewed as sort of the bad actor. And I think there's many examples globally, whether you're looking at Canada or Europe, where the countries that have figured out ways to incentivize economically, more affordable housing, whether it's increasing supply in the right areas or making housing affordable. Like those are, I would say, positive things for the industry. And I think when we talk to our management teams, they are very much willing to be part of that solution. And it's also really important to highlight, like within our universe, these are rental housing plays, and they have been able and have been over the last number of years within this housing unlock and home ownership affordability issues. They have been the more affordable solution for people who can't afford to buy a home. So I think that's important to recognize. Of course, they need to be thoughtful about what incremental supply could mean in each of their markets. But the reality is, I think as a nation, there's select pockets that are underhoused, but then we also have pockets that are have seen oversupply, right? We just talked about Sunbelt apartments. I mean, home builders have seen pockets of oversupply in Texas and Florida. So I think we need to be really thoughtful in terms of thinking about what the issues are. And I think the part that we all need to focus on, which I think is good for everyone, is that focus on affordability and mortgage rates and how that could benefit housing broadly.
Mhm. We've got another audience member talking about specialty storage, such as climate-controlled, museum-grade, or other fine art facilities. John, self-storage has not, they've run into problems. They're not always welcome in cities. They're not a big employer, but they take a big footprint and all that. But what about specialty storage? Could you speak to that for our audience members?
We haven't really seen REITs jump into that. I know it exists, and we've seen some growth in kind of outdoor storage where you could store your RVs and your boats and things like that. But I have to say, specialty storage of fine art, wine, things like that, not something that we've delved into. I mean, I do think on the self-storage front, obviously was one of the best performing property sectors kind of during COVID. That drove a lot of new supply into that market. Supply can come into that market very quickly. It's taking some time to kind of sort out the supply demand dynamics, obviously, and that's a sector that sort of has continued to post good operating performance, but has had trouble growing rents because of the amount of supply that's come into the market.
G, another audience member is asking if we have any thoughts on timber and cold storage trading at 5-year lows, according to our questioner. Would this be a buy opportunity? Are they going to take a ride up in 2026? What are your thoughts on that?
The two big underperformance, but very different demand drivers. Timber, I do think, as we just spent a few minutes talking about the potential housing policy. And I think to the extent we are able to, and honestly, I don't know if it's going to be a dramatic V-shaped recovery in the housing market because there's a lot of challenges to work through. But I do think that if we see lower mortgage rates, that's able to gradually unlock incremental existing home sales and volume and demand, that is going to help the timber REITs. So when we think about timber REITs, the pricing has been actually okay, but the volume has been relatively muted just because the housing activity has been relatively muted. So I do think that as we see that recovery path, that means higher demand for timber stocks. So I think that you could sort of see that positive kind of thesis play out. Cold storage, I think. From a valuation perspective, obviously trading at multi-year lows, I do think that there's some secular challenges for that industry, whether you're looking at sort of the GLP-1 impact on food consumption and volume, whether you're looking at sort of the cow herd at sort of relative lows versus historical levels. But with that said, it is cheap. So I think that's probably more idiosyncratic in terms of what the individual companies can do, whether it's, operational efficiencies, whether it's capital allocation. So I think that one is less about the sector, but more can the companies do something that will, help change the narrative around their companies. So that's a little bit different.
Hmm.
Yeah, just one note to add on. It is interesting. So obviously early days in 2026, but timber is one of the best performing sectors so far this year, followed by self-storage. So we are seeing some turnaround, at least early in the year in some of these sectors.
So to both of you, disruption has really become the word or the macro force of the day. What about real estate, disruption of real estate? We saw e-commerce disrupt retail, at least temporarily. We saw COVID disrupt office, again, at least temporarily. What other types of disruption might real estate be facing, say, in the coming 5 to 10 years? I mean, obviously, we hear a lot about AI. Is AI going to make a big impact? Maybe what other technologies do you expect to be somewhat disruptive for the real estate business? That's a jump ball. Go jump right in there,
Well,
G.
I'll give you my thoughts. I
Okay.
do think that one of the things that in some sense has sort of been on the horizon for a long time and maybe had a number of false starts, but I do think the increased adoption and maybe consumer willingness to adopt different types of automation will is really going to start to come into play over the next 5 to 10 years. I think self-driving cars, which sort of we're supposed to be here a number of times. If it feels to me like the technology has gotten much closer to prime time, especially in terms of some of the specialty providers operating in places like San Francisco and Austin, Texas. It's a very impressive product that can have a real impact on where people choose to live, how they get to work, how their commutes are structured, and can play out, I think, in a lot of different ways that we really don't understand yet. So that notion of automation, particularly with driving, but I think we also may see adoption of some in-home automation that really changes people day-to-day living in ways that might be far more dramatic than Mike, as you suggested. I don't think anyone going into COVID would have thought it would have a permanent imprint on how we use the workspace, but it really, in the U.S. at least, it has. So we may see more change out of some of these technological changes than we expect.
My personal view is that the technological changes going forward, we probably need to be more discerning than say, bad for office, good for data centers. I think it's going to be more specific than that. So, for example, John's example about automation, like that's a great example because it really helps us think about AI broadly, and technology changes and what cohort of the population is going to be impacted and what does that reskilling and new job creation could look like. So right now there's this debate of course, like robotics and automation, you would think would be more impactful to blue collar, but the initial reaction for AI is that it would be more impactful to white collar because that's going to be the professional services and the back office. So it's actually when you kind of play all of that out, it's not so obvious that white collar is going to be the loser and blue collar is going to stay stable because you can replace certain blue collar jobs with robotics and automation and things like that. And then also the age cohort, right? Like right now we're seeing the college, the undergraduate college population and the unemployment rate there be quite elevated. So the initial reaction would be, well, all entry jobs will be eliminated. But let's not forget that that is the generation that is going to be the smartest user of AI technology. So it's not smart to not hire younger workers. And by the way, when your middle and senior level get older, how are you going to backfill those? So I think there's a lot of initial knee-jerk reactions about what this is going to look like, but I think the reality of how it plays out is going to be more complicated, and we're spending a lot of time on that. One thing I would say is that I do think the concern about AI jobs has probably been part of the overhang for office. Like even today, we heard about large banks cutting jobs, and the initial reaction is, of course, it's AI related, and they're going to let go of their workers because they are gaining operational efficiencies. I would say for us, I think it's responsible as investors to look beneath the headlines and really think about, where is that reskilling and where is that new job creation happening? And I think that's going to be more important to focus on. So I hesitate to say like this technology good for this, bad for that, because I think there's a lot of things that are evolving. And I think, sometimes those headlines could create opportunities for us to, change our positioning and take advantage of that dislocation.
We got a lot of questions from our audience that we didn't get to. Our time is up, but as much as possible, our panelists will go ahead and get in touch with you and provide those answers. But as I say, our time is up. So John Worth of Nareit and Ji Zhang of Cohen Steers, we thank you for sharing your data and your insights. And to our audience members, we thank you, of course, for attending and participating. And please be apprised that our next REIT webinar is scheduled for April. And though we don't have a specific date, keep an eye out for the publicity and registration information for that one. We hope to see you there. On behalf of IREI and Real Assets Advisor Magazine, this is Mike Consol, wishing you a good day and a great first quarter of 2026.